Well, welcome to Dairy Livestream. I'm your host, Corey Geiger, managing editor of Hoard's Dairyman. We are broadcasting from the Cheese Cave, our studio in downtown Fort Atkinson at the historic W.D. Hoard & Sons Company building, commissioned by Wisconsin's 16th Governor W.D. Hoard and founder of Hoard's Dairyman. Our conversation today will focus on how much milk will be produced in 2022. I'm so pleased to have three great analysts on this episode of Dairy Livestream to share their insights to potential milk production outcomes this year, as well as the dairy product demand forecast as we continue to navigate the health pandemic. This Dairy Livestream episode is made possible thanks to generous support from our friends at AMS Galaxy USA, who bring precision equipment to U.S. dairy farmers. Focused on technology to improve efficiency, AMS Galaxy offers a variety of solutions to improve the lives of cows, calves, and the people who care for them. AMS Galaxy offers solutions by dairy farmers for dairy farmers. Learn more at www.amsgalaxy.com. As a reminder to everyone in the audience, this webcast will be available on our Hoard's Dairyman YouTube channel 24 hours after the live event. Dairy Livestream is also available anywhere you like to listen to podcasts, including Apple Podcasts, Spotify, Google Podcasts. Search for Dairy Livestream from the convenience of your smartphone. And again, as you hear from our panelists, submit your questions into the GoToWebinar control panel. Let's get rolling on the conversation. How much milk will be produced in 2022? We welcome Phil Plourd to Dairy Livestream. Phil is president of Blimling and Associates, a dairy industry consultancy and services division of dairy.com, a provider of technology solutions and actionable dairy market intelligence. Phil has been involved in dairy market analysis, research and forecasting, and risk management activities for over 20 years. He draws on that experience to lead an expert team who are committed to helping clients find better ways to do dairy business. In looking at our panelists today, I just might be the most bashful of the four. While that's an exaggeration, we will take a different approach to this Dairy Livestream. Since Phil's interactive and debate style personality pairs quite well with Andy Novakovic and Mark Stephenson, we're going to put out discussion topics out for debate for all the panelists. First, let's take the pulse of our audience with this poll question. What might profitability look like on U.S. farms this year in 2022? Make a lot of money, eke out a profit, break even, costs will eat up the milk check. So go ahead, we want to hear what you're thinking, and then we will go ahead and talk a little bit further about that. So we'll give everybody about 5 more seconds to give us their opinion here. And obviously there's no correct answer to this because we're trying to see what the pulse is here. So let's go ahead. We're well over 2/3 have voted and see what we have got. So we're a little bit all over the board, but 41%, that's the leading answer, eke out a profit, and 34% are concerned that costs will eat up the milk check. Phil, the opening word is yours. What's your reaction to the poll question? What might profitability look like on U.S. farms this year?
Well, it's we're amidst a fascinating race between milk futures prices and the prices of dairy commodities and grain prices. And so, you know, as we sit here this morning, we're looking at a corn market that's well, we opened 50 higher, up only 15 cents today, but corn is right up about $7 per bushel, nearby corn. That's a big number, but I'm also looking at a 12-month futures strip right now that is just class 3, that's just under $22, so $21.96 last on my screen for February 22 through January 23. So we've been watching this, so far milk futures prices have kept up mostly, or even been at times ahead of grain futures prices. So it's always dangerous to talk about what's true on paper, but on paper, margins look pretty good. We have DMC margins up over 11.50 per hundredweight, and that number, the milk futures have been ahead of the grain prices recently. So, are those numbers representative for enough people, for everybody? Is that eking out a profit? I think that's, that's certainly for the audience to know or decide. But it has been quite a horse race, and then this morning we're galloping in all sorts of directions.
That's for sure. Andy, does your crystal ball look like, or should I say cloudy crystal ball, when it comes to the milk price cost side as to its impact on milk production? Mark, go ahead.
The forever zooms in. You gotta unmute yourself. The answers to the profitability question, I think, are revealing. There's nobody that, or not, relatively few people that are super optimistic, but there's still a range, and I think that range probably also is a reminder that there's going to be a range in responses. When we look at milk and feed prices, we're looking at the two biggest factors that we know drive profitability. It's embedded in the dairy margin coverage formula that you can see on Mark's website, graphed out, that would say, looks like on that basis, margins are going to be pretty favorable. But the big thing this year that's different from our common everyday assumption is that non-feed factors are moving also. And of course, they always move a little bit, but generally we've kind of thought, there's not enough there to usually drive it. Well, you look at fertilizer and other inputs if you're talking about growing. You look at potential interest rates if you've got operating debt, or if you're thinking about a capital improvement. If you're thinking about a capital improvement, all that stuff is gobs more expensive than it used to be. To me, that's a little bit harder to predict. We don't have as easy data. We don't have forward markets on all that stuff, and so to me, that could be a real constraint. I think this is probably also one of those years where if you're in a production system that grows all or a big chunk of your feed, you're probably in better shape than the guys that are buying. That's happened a few times in these last few years. And the other thing that I'll mention in that regard is, we're the homegrown feed. We're talking about, the next half year, but basically the first 3 quarters of the year, and then what happens next fall. And with all of the crazy weather that's probably associated with climate change, that could make a huge difference, not only in total, but in different parts of the country. Mark will probably talk a little bit about what's going on in the West versus the traditional areas around the Great Lakes. And so those are pretty big factors that are going to come into play here as well.
Mark, are we in a different phase due to higher expenses and the potential focus on equity preservation, or what does this production forecast look like to you?
Well, I'm kind of reminded of that saying that chefs use, that you eat first with your eyes and then your mouth, right? And I think that dairy producers will have a real tendency to focus first and foremost on the milk price. And then, you're going to take a look at, well, how badly are the costs eating up that milk price? And it's significant this year, but that milk price is alluring. It's going to be something you want to grab as much of as you can. That said, we talk about the inflation. Andy talked about even the non-feed cost inflation that we have on farms, and it's real. If you look at the data that the Bureau of Labor Statistics puts out, our inflation has been running around 7% here and above 5% for the last, almost a year, or getting close to it now. That's a significant number, but that doesn't really apply to the farms. If you look at the producer price index, that basket of goods that manufacturers are buying and selling and using as inputs, that's up more like 19%, which is to say that's a pretty big chunk of change out here, and it is going to be eating into the margin. I do think the margin's positive. As Andy pointed out, it depends on how much of those inputs you're actually producing or growing yourself as opposed to purchasing, but even the inputs for growing it yourself, the fertilizer prices and things, very high this year. So we'll have to see how it plays out, but I think we're going to produce more milk.
It's kind of funny, guys. I mean, in our internal network here at Blimling and Everag, the conversations we have on Slack, This morning I'm seeing, credible talk in our network of, cost of production numbers being tossed around that are well north of $20 per hundredweight. 2021, and these are for producers in the West, which is kind of, intriguingly, right? Because in these high feed markets, those guys, the feeders, as Andy and Mark, stated, the feeders bear the brunt of it, the people buying feed. But it's really, those are big numbers, but milk prices, look like they're close to 22, 23. So, it looks like we're covering those costs, but it's a very, and I would say this, like crazy stuff, right? Like ethanol production has been kind of up and down. I talk to producers who are having trouble getting DDGs, not because of transportation, but because the local ethanol plant is not running as hard as it was, and they're running short. And so and then if you're in the West and you're paying, for all right, so corn's $6.50, $7, whatever it is, but the transportation costs that we're piling on top of that are up really sharply, right? So dry van rates, reefer rates, flatbed rates, they're up 30% year over year. Here's another one, hauling, right? Milk hauling, spot rates for milk hauling, close to $6 per hundredweight, according to the dairy.com stuff that we keep track of here. Well, that's up 50% year over year. Now, who's paying for that at any given time, can shift around, but those are all costs that the sort of published models probably aren't fully, right? Mark's DMC model, our DMC model, we're not fine tuning it for the local basis numbers, in any given point in time. So I think that the true costs are definitely higher than some of the published indices would suggest. I still think farmers are going to make money if we took a snapshot of the board right here, but it is very bizarre times on the cost side.
Yeah, and I would just say also, I'm not trying to put a plug in for you, Phil, so don't worry about that. But if you look at the futures markets right now, I'd just say grab some of these profits. Don't get way too greedy thinking we're going to have $30 milk. Just try to grab a little bit of these profits. Nobody ever went broke locking in a profit.
Definitely time to sit up a little straighter in the chair and pay attention when you see the kind of numbers that are floating around.
Well, let's extend this conversation. To do that, we're gonna go to another poll question. And this is, again, a reaction of our audience. What will be the milk production response by U.S. dairy farmers in 2022? Up more than 1%, up less than 1%, flat, down less than 1%, or down more than 1%. So you guys can go ahead and do that. Obviously, we're on a 3-month roll here of milk production being down, but that doesn't mean that's the future. So we'll give everybody a little bit of time here to continue with that poll question so that we can all hear and see the pulse of our viewers. So let's go ahead. We're well over 2/3 have participated. So there's a lot of optimists out here. Doing some quick math, 75% here are saying that milk production will be up, but the biggest category is up less than 1%. Bill, we're going to start back with you here. Yesterday during dress rehearsal, we used the word potholes, or Mark used the word some economic tension points. So what are some of those potholes or economic tension points that could impact milk production projections far beyond income and the expense discussion?
Well, I do think that the income, that sort of true expense versus, on paper expense is certainly a big deal. But yeah, I think that, one of the things that we're looking at today that we were not looking at in as big a way, the last time around or ever really, is we do have a lot more base programs in place. And so there are various programs that in one way or another are limiting output for producers in many regions of the country. And so while it's tempting to say, well, hey, $22 milk, decent profits, here comes the flood, and that may still turn out to be the case, I do think that there's more supply mitigation or management or private programs in place that are designed to keep us from getting too carried away on the rebound. And we don't really know. We have a sense. History says we'll make more milk when there's more money. I lean a little bit harder in that direction, but I think inarguably there are different measures in place today that could shallow or alter the trajectory compared to what we've seen historically.
Bill, well, it's not easy to put a number on it, but we can at least put a range on what percent of milk in the United States is under a base excess program. I've seen different numbers. Most of them have been above 50%. You want to go any stronger than that on a projection?
Again, we don't know, but I would say it's just in the 50% or maybe a little bit more category. I would think, just, if you just kind of start ticking down the list.
Yeah, I'm going to just also say that 50% is a number that I hear too, but that suggests to me that there could be leakage in the system. In other words, if you really feel like you want to respond to milk production and a base plan is not letting you do it easily, there may be in your area some alternatives. And I don't know how accessible they'll be, but certainly some. And I suspect that if there's profitability, then we're going to find a way to produce that milk and get it to the market. And that unfortunately, I think, also tears away at some of the supply coordination that people are trying to make with these kind of base programs.
Is it possible too, guys, that again, I'm not an expert on all these programs, but some of the prices might be high enough that people will take the penalty, right? If the price is $23, some of these programs, the way they operate, it might be, you still might make some extra milk. I don't know for sure, but that thought comes to mind as well.
Yeah, I sure don't know what the nature is of all these programs, but the ones that I've heard about in the Northeast sound pretty tough. Earlier versions, pre-pandemic, there were a number of programs on the books that didn't amount to much, but I think, at least what I've seen in the Northeast, that's really changed. Corey, one of the things that I've thought about a lot, I wish I could get some kind of data or something to understand it better, is the contrast between controlling or restraining production growth with these, what I like to call growth management plans, versus a couple other versions that we've been more familiar with. Obviously, price is one way. You get the price low enough, you beat people over the head enough, and some folks just hang it up. Typically, those folks that hang it up are ones that are close to retirement, where it was kind of a feasible lifetime option anyway, a stage of life option anyway, and some just can't hack it and go out involuntarily. Those two groups, the ones that are kind of on the edge and the ones that are approaching retirement, probably weren't planning on growing anyhow. The other one that comes up from time to time, of course, is a strict quota, Canadian style. And when you impose a strict quota, it goes on everybody. It goes on the little guy, the big guy, everybody. This growth management approach is about restraining growth on people who wanted to grow. And to me, that's really significant. It's significant in a lot of ways. And you're not really introducing a constraint on folks that weren't planning on growing anyhow. And what you're really doing is restraining the folks that in many ways we're going to be kind of the lifeblood of the next generation. And, we can debate whether their plans are good, bad, or sideways for society or whatever. I'm not interested in going there. But I think these growth management plans are restraining who grows in a very, very different way than other things that we've done. And to me, that's kind of significant. And it makes me wonder, for the guy that just, has so much money and decides, what the heck, I might as well build one in South Dakota. I don't know about them. But for the middle-sized guys who, got a kid coming back from school, or, brother wants to come into the business after serving in the military or whatever, to me, those, I think, are things that are worth thinking about.
But isn't it about capacity at the end of the day? I don't think that my sense is that these programs are as much oriented as, okay, we got X amount of plant capacity in this region, and we can't sell milk at $4 under because we've got too much of it. We can't process it in our own backyard. And so there's sort of this dance between, it's smart growth on a lot of different levels, right? You have, Idaho producers have been restricted in one way or another for the past couple of years because there's no new investment on the plant side in Idaho. So it's not sort of and it's a mixture of co-op and private programs. It's all over it's not one monolithic program that's operating there. It's like, hey, there's only so much cheese plant or whatever yogurt plant capacity here in this state. We can't keep shipping milk out. And so there's this dance between, okay, well, when are we going to build the next plant? And when we build the next plant, are we going to grow behind it? I know, and I think that's more of a Western phenomenon that deals with larger producers than what you're talking about, Andy. But even the Northeast, right? Where does the extra milk go has been the real challenge. So it's this coordination between, capacity. So I don't think the supply programs are just to have supply programs. I do think it's an effort to try to match up against capacity, which can get tapped out regionally.
Oh, absolutely. And I think the Northeast is probably the poster child for that strategy, where cooperatives, who are usually the ones that are owning these facilities, have said that it's just not profitable to build class 4 plants simply for the purpose of sucking up milk. That the profit equation on that isn't good, and it just makes more sense in their view to restrain growth. And that's a business decision, and I can figure out that kind of math. I think part of the question, though, is whether or not there exists some unused capacity because of the goofiness of the pandemic that could take on more milk. But even more importantly, I think is a question of what's going to be the change in demand, because plants don't buy milk just for the sake of filling up the plant or whatever. They've got to have a place to sell it. And I think one of the features of these growth management plans is, before we did this, demand was always chasing supply, and price had to figure out how far it had to go down or wherever it needed to go in order to get enough demand to match up with production. Now, with these growth management plans and a kind of a more overt intervention by primarily cooperative managers, boards of directors, and so on, it's really supply that's chasing demand. And so I think a really big question in terms of how much production we're going to have is how much demand are we going to have?
So
Yeah, I think that's an important point, Andy, because, in talking with a lot of plants over the years, I've tried to ask that question about what is your maximum capacity? And, it seems like you ought to be able to give that with decimal point precision, right? But you actually can't, because, what if we put on an extra shift? Could we do that? Yeah, maybe. So you have to think about, really what is the maybe equipment capacity if you're actually thinking about complete capacity. And then you also have to consider, do we have the sales for the product? And that's a pretty big question that folks, have a difficult time answering. My understanding, we've got some plants that are not accepting all the milk that they ordinarily might, simply because they can't get the labor to run that extra shift. That's become a constraint in a few plants. And yet you'd have to ask, well, how hard are you trying to get that labor? Are you prepared to pay, $25 an hour or something to get people in the plant? I don't know.
Mark, a conversation between Mark and Phil earlier, it resulted in this audience question. What would we expect to be a decent level of milk price protection in this environment, or not willing to pay the cost so the markets are moving. What should a dairyman or dairywoman look at here under these upward moving milk prices? But you also, Mark pointed out, that no one's ever going broke locking in a profit. How does this dairyman that asked the question go about thinking about that?
If I go first, look, I almost feel like I got to give the disclaimer, but it's hard. There's no one size fits all advice. But here's one thing I really, really believe in after years of watching this: the time to think about managing price risk is when prices are high, not when prices are low, right? And so, and the danger is that once the market gets to $22, everybody starts talking about, well, we're going to 25. And then when we get to 25, we're going to talk about how we're going to 30. And then, and all of a sudden we wake up one morning and the bid is gone and woof, it's over. I'm not predicting a cataclysmic decline. I don't see a huge amount of downside risk tomorrow morning, but and I think that, and then I will speak selfishly because my colleagues and myself peddle this stuff, but some of this dairy revenue price protection insurance, certainly the DMC program. The cool thing today for dairy producers that want to manage risk is that there are really big, good programs around that protect the downside and leave the upside open. And so, it's not so much, okay, I'm going to stick to $22 period. You can buy floors through DRP and DMC is a put, right? And so there's no reason not to be signed up for DMC on the 5 million pound max if you can get there. And then on DRP, the cool thing about DRP is it's subsidized puts at the end of the day. And with these kind of numbers, okay, so you might spend a little bit of money to protect Q4. I have to look at the prices here, but you can protect really good numbers. And so I don't know that you have to do it all today. You can walk into it. The great thing about DRP is it's very flexible. You can match components in class 3 and class 4. You can marry up to your milk prices as best you can. But the really cool thing is it's subsidized and you still have the upside open. So if the market goes to $27, all right, so I spent 30 or 40 or 50 cents on DRP. Who cares, right? Yay. So I think that's, I just think that's the really cool thing about risk management in the current environment is that the insurance programs are really, really valuable.
So let's go to one more audience question here. And this comes from a longtime viewer and an industry colleague. And certainly given the changing components of milk, he is raising a fair question. Should production be measured in terms of pounds of component instead of pounds of milk these days? Is it possible that pounds of components are increasing at a greater rate than milk production? Andy's nodding his head.
Yes.
Go ahead.
Well, I would just say yes. I think it's sensible to do that. I mean, most of the rest of the world is basing payments on the pounds of solids that you sell, or kilograms of solids that you're selling, as opposed to the volume of the milk. And yeah, I mean, let's acknowledge we get paid for the components anyway. And if we're talking about some of our base excess program, it should probably be on the basis of component sales as opposed to the volume of milk sold too. That's just my opinion.
Well, and you tiptoed right to the edge there, Mark. It's absolutely true. I mean, from what I know, all the base excess programs are putting a regulator on milk pounds, but that's also why the component levels have been moving upward so much here. The upper Midwest order for 2021 just went over 4%, and proteins at 3.17 on shipped milk. I mean, that's up from a 3.7 a decade ago. So that's a really evolving story here. Phil or Andy, anything to add on that area?
Well, I would just say there's kind of two different questions here. One is, how do we measure production? Somebody says, what happened in production? What's our answer? What's the number that we're looking at? And I think this conversation is saying, yeah, pounds of milk isn't really telling us the whole story. USDA publishes data on pounds of milk fat produced and pounds of skim solids produced. I don't know how blisteringly accurate those data are. I would assume they're good. And we can look at those. I confess I haven't poured through those numbers recently, but we can look at those and we probably will see exactly what Mark has been saying. Solids content is up, and so you look at that number and you'd say production is growing by more than if you just looked at 88 pounds of water. The different question is, would we have a different outcome if we paid for pounds of milk fat and pounds of skim solids, which is actually really common in other countries, so don't pay for liquid volume. And I'm not so sure that would make much difference in the incentives farmers have. But the other one, how do we understand production changes sure would make a difference. And I'm pretty sure farmers are clever enough to know that they can sell pounds of solids and have it add up to 100 and have a little wiggle room in a growth management program.
I think that's an interesting point, but at the end of the day, I mean, look, I love data. I could, happy to flash to my screen with 500 spreadsheets at any given point in time. But at the end of the day, the market knows, right? I mean, you can measure, and we measure by more than milk production, right? We measure by cold storage figures. How much product do we have in storage? We measure by export figures, right? I mean, we measure all sorts of different ways. And at the end of the day, you can't fool the market for very long. I would say that one of my favorite indicators is the weekly spot milk price data that USDA puts out, because that's like a real-time indicator of where we're at. Are we long or are we short? And whether that's up, 0.04% or 0.07% or whatever, at the end of the day, the market figures out, how much is for sale and who wants it. Is more important, I think, than, I mean, academically, look, and I'm sort of I'm definitely the academic lightweight in this collection. Academically, it's very interesting, but as a practical matter, the market always adds color to the data, and the market knows.
Yeah, well, I would just say that in the support of transparency, it would be nice to be able to talk about the things that at the end of the day actually matter. And I'll go so far as, maybe you'll clutch at your chest, Phil, and go, oh, no, don't say that, don't say that. But I think that if we had futures markets that were based on, 100 pounds of butterfat and 100 pounds of skim milk solids instead of 100 pounds of class 3 milk, let people protect what's important to them at the time. I think it would be an easier thing to have real risk protection. I think it'd be an easier thing to be able to talk about how well supplied the market is. We aren't drinking this anymore. We're eating this stuff. So, let's talk about solids.
Oh, I at times as we thought about risk management, how we trade this stuff, I would be in that camp. There's all kinds of sort of tentacles around it. And again, it's one of the reasons that this DRP coverage is intriguing, because it does allow you to dial in some components on the risk side of things. So, no, I think that opens to me a whole Pandora's box of how we price milk and what's out there, and there's that gets messy very quickly.
Oh yeah, but we still announce a butterfat price, and we still announce a protein price, and I mean, what the heck? We can settle to that.
So I'd like to jump in and remind our audience that you can go ahead and ask questions in the GoToWebinar control panel. And I'd also like to thank our DairyLivestream sponsor, AMS Galaxy, who brings precision equipment to U.S. dairy farmers. You can learn more at www.amxgalaxy.com. Let's go back to these potholes and economic tension points. Some of them, and I'm just going to list a few off. I won't get them all. But we got sex semen, we got beef on dairy. Mark used the word tougher feed, or what nutritionists would say less digestible. Or will farmers even delay culling some potentially production cows to increase milk here? What are some of those? How might some of those things factor in here to 2022?
The heifer numbers are really interesting to me. The U.S. heifer gender selection, breeding, sex, semen came into vogue. Our heifer numbers over the years got really aggressive. Peaked in 2016 on the January 1st inventory report at 4.8 million head, and that was the ratio of heifers to milking cows was 52%. That was an all-time high, at least as far as the USDA data goes back. And so we kind of had a moment there where wherever you turned around, you could find a dairy heifer. They were cheap. They were all over the place. Since then, we've seen sort of a sequential ratcheting down in that population. And the January report this year, the population was down to between 4.4 and 4.5 million head, and that was somewhere between 47 and 48% of the dairy herd. So we've seen this sort of crest and downturn in the heifer population, and we can talk about why that is. But in practical terms, when it comes to how quickly we bounce back on the milk production side, you just can't snap your finger and find 50 heifers the way you could 3, 4, 5 years ago. And that, I think that is, that definitely is a constraint on the speed of growth.
I'm going to jump in real quick, Phil, because your heifer numbers, inventory numbers really pair up well with this observation. And this is based on U.S. semen sales to dairy farmers from the National Association of Animal Breeders. So in 2017, beef semen sales passed through the 2 million threshold for the first time. 2 million in 2017 and all the way up to 7.2 million in 2020. We don't have 2021 numbers, but 2 to 7.2 million, that's a lot of beef calves coming out of dairy cows and certainly impacts that. Now, the other barometer there is sex semen. So those two, Phil's discussion and the semen sales do mirror up. What about some of the other tension points?
I think that milk per cow is interesting too, right? This last production report certainly showed dairy cow numbers well down, and that speaks to capacity. But I'm interested in what's also driving some of that milk per cow. Is it just that feed's expensive, or is it that the feed quality isn't where we expected it to be? We're having a hard time getting milk out of cows, or are we just taking our foot off the gas and just saying, cows, let's stroll for a while instead of running all the time? I don't know. But I think quality is an issue this year.
I think anecdotally, we would agree that, I think you've seen rebalancing of rations for any number of different reasons in many regions, cost, availability, et cetera. I think that's definitely happening.
Mark is a guy who's got a degree in animal science, and in addition to ag econ, and more farm oriented. Corey's more farm oriented, so I could be a little off base here. But while you guys were talking, I looked up the USDA numbers on 2021 production for both all milk, milk fat solids, and skim solids. The all milk number, if I didn't do my math wrong, is 1.4% for 2021 milk over 2020, 2.8%, double for milk fat, 1.9% for skim solids, so not double, but up. How the hell does that happen? Well, yeah, I think, William Dempster Hoard's investment in Guernsey is probably, coming to bear in here a little bit. And that would also would correlate with what we're seeing in production per cow. We're looking at pounds volume of milk, and we're saying, oh, it's looking a little slack. Well, if we're browning out the herd, you'd expect that, wouldn't you? And these data, to me, when you talk about that much difference, double the growth change in milk fat production relative to all milk production, that's hardly marginal. There's something going on besides, I'm feeding differently. So I think that plays into this. And I think this really gets to the question of what tools do dairy farmers have right now to pivot on milk production. A lot of us have made a lot of speeches where we say, hey, it's not a light switch, you can't turn it on and off, blah, blah, blah. 100% true. I made this speech many times and thought it was a good speech. But the reality is there are things that you can do. And a real question is, do I have some unused capacity? I don't think we got a lot of overstocking going on. I think we maybe have some understocking going on because of this growth management. Is there space to fill up? If we're browning the herd, maybe that also speaks a little bit to feed availability. How much pounds do I have per cow compared to what I was budgeting for a big Holstein, et cetera, et cetera. So I think there could be some buoyancy in the ability to produce milk to countervail against some of the potholes as well. And I'm going to come back to saying, I think that could be unleashed, but it's going to be demand led, or it's not going to happen because of the growth management plans.
But look, 2021 and 2020, we are just a bit of an exception, but we told dairy farmers for 5 to 7 years that fat was valuable, right? When butter went to $3 a pound for the first time and, was averaging well over $2 for months and months and months, we told dairy producers, hey, this fat is valuable. And what did dairy producers do? Right? They made more fat. And so I'm kind of surprised that the fat numbers held up as butter prices moderated a little bit, but now butter's way up there again. So I do think that the browning out of the herd, I mean, I think that, you know, all kinds of genetic stuff that's going on, period, but also, and I wish we had the numbers. I don't always have them. I don't know who has those numbers, but, you know, I mean, I think that the number of Jersey cows in this country in milking herds and Guernseys, to be fair to Mr. Hoard, I mean, I think that we have brown Swiss cows, to be fair to my brother-in-law. You know, I just think that we told farmers that components were valuable. They're making more components, and fat was the most valuable of all, and they've done it. And I think the capacity has been there, right? I mean, fat went from a certified killer, you know, 20 years ago, 15 years ago, to being, you know, au courant in a big way. So I think all those things, none of those things they all intermingle, don't they? And I don't know why is that going to change? I mean, I think you might see some, all right, it's a little more expensive to feed this way or that way, but I don't know, why would we go backwards on any of that?
So one of the ways we can measure what that dairy herd looks like is going back to the National Association of Animal Breeders semen sales numbers. And just using round numbers here, 14%, and again, this is 2020 data because 2021 isn't tabulated, but 14% of the semen sales were Jersey and 84% were Holstein. So those two breeds are accounting for 98%. So there is growth in the Jerseys, but the other big thing that's happened between genomics, I mean, we're about to have 6 million animals genomic tested in the United States in the past decade. That's a tremendous investment there. But it's also on the bull side there because the generation interval is being compressed, and the component levels in these young bulls, I mean, farmers are buying semen from bulls with high component levels. They're responding dramatically. If you look at a bull list of the top bulls from a decade ago to now, it is, and you miss 10 years, you'd be like, what just happened here? Some of the Holsteins look like they got component levels of Jerseys and Guernseys. Now, the breed hasn't changed that much, but it's a shift.
Yeah, and if you look at the data, I mean, 4.01% average fat test in the United States on fat in 2021, and that's a first. And we were at 10 years ago, we were at 3.7%, 3.72 in 2012. So I mean, that's pretty
stunning.
remarkable. Yeah.
Stunning is the right word. Remarkable, stunning, those are all good adjectives. So there's areas of the U.S. that are growing, and there's areas that aren't. And just a couple of numbers that just came out yesterday from USDA and looking at the 2021 production data. The top 7 dairy states grew by 1.7% last year. That's when you look at that, you know, you think of California, Wisconsin, Idaho, Texas, New York, Michigan, and Minnesota, and the other 43 dropped back 4%. Then there's like Wisconsin, a remarkable story. They produced an extra 953 million pounds of milk last year, almost 1 billion pounds. That's something that hasn't happened in this state in generations. And then Texas, the last 5 years, 4.8 billion pounds of new milk, equivalent of what all the number 14 state Arizona makes. What are some of these, what's changing in some of those regions versus the rest of the country?
Well, I think if you started to drill down, you know, Corey, and take a look at, you know, under the microscope, and, you know, instead of under the magnifying glass, I think you'd see that it's who's expanding, you know, who's providing that milk production. It's amazing. I've followed these growth by herd size categories, and the 1,000 to 2,000 cow dairy herds have been expanding somewhat. The 2,000 and up is where the real growth and expansion has been, and below that, no growth in milk production at all under any of the other herd sizes. Now, surely we've got farms that are graduating up into the next, larger herd size along the way, but we've got farms dropping out as well. So, when you're saying, how are we getting that kind of growth? It's almost always been a matter of, or not always, in the last 20 years, a plant is either greenfield being located or adding substantial capacity, wanting more milk, and saying, as our conversation was earlier, let's bring it on. And we've got farms that are responding to that. Maybe, new greenfield farm as opposed to growing internally. It's not growth between the cracks. In Wisconsin, you got a little bit more of that growth between the cracks, partly because, we can't find 3,000 acres of land contiguous available for purchase, to plop down a new big operation. So it tends to be more growth in between the cracks up here. But in those other areas where we've witnessed dramatic growth, it's just new big farms.
Mark is pointing out the growth potential in Wisconsin. I think it begs the question, is that really all that much different from the growth potential in South Dakota or New York, or pick some other state you like? And I don't know the answer, but I think there is growth potential in Wisconsin. However, I want to connect this back to a comment that I think Mark and Phil talked about earlier, and that is how much of the milk supply is subject to a stiff growth management program, and connect the dots to having a lot of proprietary cheese plants in Wisconsin that maybe means there's been less restraint in Wisconsin than in some other locations. So maybe the question is how much growth potential is there, but maybe the other question is how much has that potential been suppressed other places?
Yeah, I mean, I would say that just anecdotally, I think there are fewer management programs of any sort operating in the upper Midwest. Have been, there's been some soft stuff going on, but in terms of what we see in the Northeast, we don't see as much anything like that here in the Midwest. So I think there's definitely some truth to that. The other thing I'm fascinated by is there's some of this shift back to what Mark was talking about of what used to be big versus what is big today. And, if you look at one of the huge areas of contraction or retreat in 2021, it's been New Mexico. And 20 years ago, New Mexico was the promised land, and where we saw, its biggest average herd size. And, we saw these 2,000 cow massive dairies in New Mexico. And now, as things have evolved, New Mexico dairy farmers, generalization, they pay more for feed than just about anybody, just in terms of local feed and all that stuff and transportation. If we look at milk prices, high level generalization, their milk prices tend to be at smaller premiums or bigger discounts to the national averages. And you have like almost an aging out that's going on there, because the 2,000 cow dairy in New Mexico that once was the cat's meow, is not the same thing as a 6,000 cow dairy in South Dakota or 100,000 cow dairy in Texas. And so those, it's really fascinating to see, that, the middle ground in production to me is really shifting, and it's shifting fast and in interesting ways. What's big anymore is not, I don't, 2,000 is not big. Again, in the scheme of 2,000 is more in the middle ground or no man's land today than it was 10 years ago for darn sure.
So this is a chicken or the egg question coming from the audience, and we touched on it, but I think we should double down and clarify it. Are you saying further growth in milk production will be driven by firms willing to invest in new processing facilities? Regionally,
to some extent, yes. I mean, it was a curiosity. In the past, the job of cooperatives, your cooperative that you belong to, was to find a place to get rid of my milk. And that's been more than a subtle shift, I think, recently, to where we found cooperatives saying, we can't just keep doing this. We can't keep building capacity or going onward. Now, Michigan was maybe the poster child for that, right? milk was moving all over the place trying to find a home until they built a plant a couple of years ago. Well, that plant's online now and producing a fair amount of cheese and sopping up that milk that was spilling out of the state. But I don't think that we're seeing that much of that type of occurrence anymore. Now we're trying to imagine what are our customer potentials. And if we're doing this for export products, that's a little bit different than thinking about where can we sell this domestically.
Well, and I don't think it's and all the work that we do with people, and people say, hey, we want to build a cheese plant, and there's no such thing as a 2 million pound a day cheese plant that really works from what we've seen in the current structure. So, if that Michigan plant is 8 million pounds of milk per day, right? And everything that we hear that's on the drawing board is they're for the most part, sizable plants. Well, not a lot of people got $1 billion laying around, to build. I mean, you are talking of capital investment that is north of $500 million and closer to $1 billion, I believe, if you're talking about a cheese plant of scale of the modern scale. And so it's not hard to believe that even the proprietaries are saying, hey, we just don't have that kind of dough, just like that to go build a plant. And it took milk in Michigan to get to $3 for, the premium collapsed in Michigan. It took 3 years of that before before anything really happened. And so it's a very interesting dynamic, but the cost of those plants has gone, you have to build a big one, I think, and the costs have skyrocketed.
Yeah, but Phil, if you're processing 8 million pounds of milk a day into cheese, you don't just take that to the local farmer's market to get rid of it.
No, you need a customer.
That's a substantial amount of sales of finished product. Who's the customer that can sop that up?
Yeah. I would go further. Mark used the term customer potential, but it's a real demand question. There's two ways that building a plant are going to work for you. One is demand is growing and that capacity is needed. Nobody else is going to take it, so you've got a relatively easy opportunity to satisfy this new demand. The other one is you take somebody else's business. You're just going to be better than the other guy. That of course is hardly impossible, but it's a tougher proposition. I mean, Chobani is the great example. They ate Dannon's lunch and General Foods lunch pretty successfully, starting out from pretty humble beginnings. So you can do it. But what's the scenario? So I think we got to be really careful. If it was just to build a plant, heck, we know how to build plants. The trick is having the demand to sell the products that those plants make. And that's the hard part. We've got to really focus on that end of the line customer, not just the middle. We need more plants.
I want to jump in here. We're going to turn to discussion here because I think when we answer this question, how much milk will be produced in 2022, we got to have an international component of this discussion. And before I set that stage, I just want to thank our friends at AMX Galaxy for being the sponsor for this dairy live stream. So on the production side, the discussion always starts with New Zealand and the European Union. And so what's going on in those two countries? Are we in they've been kind of sluggish on milk production. Is that a new normal or is that just an anomaly? Phil?
I think it's a blend of factors. I mean, I think structurally, definitely, it's kind of funny in Europe, right? Quota sunset, we're going to have unrestrained milk production. Watch out. And we did have very big growth for a little while in that 14-15 area. But now we have sort of a different kind of quota system coming into place tied to environmental regulations of one sort or another. And so, you see the Netherlands where cow numbers have peaked. And could come down even further as a result of new livestock number restrictions that could come into play. And so there's definitely structural issues in Europe that are changing the landscape and are changing the growth potential. But I think so there's that. But I also think that you had weather issues last summer and you've had the same sort of margin pressures that are driving U.S. milk production to where it is today, sort of so-so financial performance for a year and a half, high feed costs last year, all that stuff played into the European situation as well. So, Europe, I think is, it's a lot of structural and some cyclical or sort of temporary. New Zealand, I mean, the weather in New Zealand is a big deal. We went too dry, and then all of a sudden we went too wet, and that's very strange how quickly that happened. But the numbers got worse in January. But I think, Mark, you were talking yesterday about, I'm not as familiar with the structural stuff in New Zealand, but New Zealand is pretty close to tapped out as well, right, from just an animal number.
Yeah, I mean, New Zealand is a country that cares a great deal about the environment, always have, and they've been very much aware of that, and they're starting to get pushback for the number of animal units that are on the land there. I'm also aware that our time is kind of ticking down. I have one thing I'd like to throw out that I think is timely today and ask Andy as our political expert here.
Okay.
What can happen as a result of geopolitics and the stuff that's going on? Is this going to be, I'll see your sanctions and raise you too? That can blow back to dairy. It has in the past. Last time we put sanctions on Russia, we saw them just saying, I'm not going to buy your dairy products anymore.
Yeah, well, obviously the Russian thing is a huge powder keg right now, and it's not too hard to imagine that kind of tit for tat, which sounds like a too calm a word for it, particularly between Europe and Russia. This sort of nationalistic approach to economies is got a lot of folks thinking, yeah, you're darn right, protect home first. I don't know where that sorts out, Mark. I mean, my instincts as an economist are in 100% in the other direction, but politically, that's got some movement. The reality is, exporters are always going to want open markets. Importers are the ones that are going to be more concerned. And which one are we now? If we're an exporter who's thinking like an importer, I'm having a hard time figuring out how that works. And I think that's going to become, sort of like I chase the ambulance and now what do I do with it? But you're right. This sort of nationalistic approach to managing economies is a lot more of an instinct in the last few years than was true previously.
Well, I appreciate Mark, Andy, and Phil being with us today to discuss what the milk production and demand forecast might look like throughout this coming year. Our next dairy live stream will air Wednesday, March 23rd, 2022 at 11 a.m. Central Time and will be archived on the Hoard's Dairyman YouTube and podcast channels the very next day. I look forward to seeing you then. We want to thank today's sponsor, AMX Galaxy. And on behalf of Phil Plourd, Mark Stephenson, and Andy Novakovic, I'm Corey Geiger, your host. Thank you for joining us today. We wish you all a good day. Bye, everyone.